Welcome to the Deep Dive. Today, we are taking a really critical look at the BlackLine Q3 2025 earnings call that was held on November 6th, just after the market closed.
And this is, well, it's a really complex narrative we're dissecting here. You've got this mature SaaS company trying to navigate a pretty difficult transition.
A transition on multiple fronts, right?
Exactly. It's a pivot to a new platform, a new pricing model, and they're shifting up market.
All while dealing with some very public pressure from an activist investor.
It just adds another layer to everything.
And what's so fascinating is the market's reaction. It felt completely contradictory.
It really did. I mean, management comes out with accelerating bookings.
And a significantly raised full-year EPS guidance. I mean, those are the kinds of things that usually make a stock just, take off.
But that's not what happened. The stock sold off by nearly 6% the next day.
So that gap, that space between the company's optimism and how the market actually responded, that's where we're going to dive in.
That's the sweet spot. It tells us the market latched onto some very specific headwinds. And our mission today is to figure out exactly what spooked investors so badly that they'd ignore a massive profit guidance raise.
Okay, so let's start with the basics. The headline numbers for Q3.
Right. Top line, GAAP revenue came in at $178.3 million.
Which was about 7.5% year-over-year growth. Solid, but not spectacular.
No, but it did slightly beat the consensus estimate. So a small win there.
Now, the bottom line, that tells a more interesting story.
It does. Non-GAAP EPS was 51 cents. That landed precisely at the high end of what everyone was expecting. On the surface, that's a beat.
But when you look at it year over year, the picture changes.
Yes,
drastically.
Absolutely. The GAAP net income it fell off a cliff. It dropped from $17.2 million this time last year down to just $5.3 million in this quarter.
And that's a number that gets noticed immediately.
For sure. But, and this is where the context is so important, the non-GAAP net income also declined. It went from about $44.4 million down to $37.6 million.
And management was pretty upfront about why, right?
They were. They attributed a lot of that to strategic spending. Mostly the costs for their big Beyond the Black customer event in September.
Okay, so a one-time thing.
Largely, yes. That and the final big costs of their multi-year migration over to the Google Cloud platform.
So we shouldn't really see that sharp GAAP drop as some kind of operational failure.
No, not at all.
Yeah.
It's more like they're in an aggressive investment phase. They're taking the hit to earnings now to build the foundation for the future.
Right. And the real health of the business is probably better measured by its cash generation.
100%. And this business generates a ton of cash. Operating cash flow was $63.8 million, up 14% year over year.
And free cash flow, or FCF, was $57 million.
Which translates to a 32% FCF margin.
That is a fantastic metric for a SaaS business. It just confirms how embedded they are with their customers.
It does.
Yeah.
But like you said, the market isn't rewarding resilience right now. It wants to see growth accelerate.
Which brings us to their operational story. Management's whole pitch this quarter was that their strategy is working.
Yeah, that the changes they've made across product, their go-to-market, all of it, it's driving the business up market.
And they had some numbers to back that up, some really impressive numbers.
The new customer bookings grew by about 45% year over year.
But the real story, I think, was the size of those deals.
The average new deal size more than doubled, up 111%.
Wow.
That's the proof right there that this shift is working.
Yeah.
They even landed their largest ever contract, TCV-wise, with a global commercial real estate firm.
So they're moving from selling, little pieces here and there to selling these huge strategic platform solutions.
Exactly. And that's all built on their new pricing structure, the Studio 360 platform. They said platform-based pricing was almost 3/4 of their new customer bookings internationally.
Which is incredible because it's only been available internationally for, 2 quarters?
The uptake has been extremely fast. And it has to be. Because that new platform is what's going to decouple their value from just individual user seats.
Okay, let's unpack that. Because this is the core friction point, isn't it? This is why the stock sold off.
This is it, the transition headwinds. They talked about 2 big ones. The first is something they call success-based attrition.
Which is just a fancy corporate way of saying their product works too well.
It's the ultimate paradox of automation, right? BlackLine's tools are so good at automating things that customers they don't need as many licenses anymore.
You, the listener, you just don't need as many people logging in because the software is doing the heavy lifting.
The irony is they deliver huge value, but under the old per-seat pricing model, they actually lose revenue. If a CFO goes from 5 accountants to 1 supervisor logging in, poof, 4 licenses are gone.
So that's one headwind. What was the other?
The pricing pause.
Oh.
Basically, large existing customers are holding off on buying more seats.
They're not leaving.
No, not churning. They're just taking a breather to figure out this new platform pricing. They have to decide if they want to convert their entire relationship over.
And you can see the combined effect of both those things in one key metric.
Dollar-based net revenue retention.
NRR, which came in at 103%.
Yeah, and that includes a 1-point hit from foreign exchange. Now, technically, over 100% is positive.
But for a company like this targeting huge enterprise clients, the market wants to see that number closer to 115%, maybe higher.
For sure. That 12-point gap is where all the execution risk is getting priced in.
And on top of all that, they're also deliberately getting rid of some smaller, lower margin accounts.
Right. They're pruning the portfolio. It's painful now, but necessary for the long-term focus. They expect that to be mostly done by the first half of 2026.
This whole move-up market, it's really supported by their tech, right? Specifically the AI.
Absolutely. The focus is on their Verity AI suite, which is built for the office of the CFO. And management kept repeating this key phrase. Black box AI is a non-starter in finance.
You just can't have an algorithm you don't understand making critical financial decisions.
It's all about trust, auditability. That's paramount. And that's their differentiator. It's not just the AI models, it's the data. They have a massive proprietary data set from over 4,000 customers.
And they pair that data with an ISO certification for responsible AI.
Which means their systems are auditable and trusted. That alone shuts out a lot of the newer, more generalized competition.
You can see that same kind of maturity in how they're managing their capital.
Very much so. They were aggressive with share buybacks in Q3. They spent $113 million to repurchase about 2.1 million shares.
That's management signaling to the market, we think our stock is cheap.
And their balance sheet is strong enough to back it up. They're basically net cash. Plenty of liquidity to get through this transition.
Okay, let's talk about the guidance, because this is where the management optimism really shined.
It really did.
Yeah.
Their Q4 guidance was a little bit ahead of what people were expecting on revenue and margin.
But the real bombshell was the full year 2025 EPS guidance.
A huge shockwave. They raised it to a range of $2.08 to $2.13 per share.
And the consensus on the street before that was around $1.64.
I mean, a raise of over 40 cents at the midpoint, that's enormous. It demands you pay attention.
It suggests they are finding some serious efficiencies somewhere.
Or that the benefits from the cloud migration, the GTM changes, are coming through faster than anyone thought.
And their long-term vision seems just as confident. They're targeting roughly 20% bookings growth in 2026.
And they're focused on the rule of 33.
Let's explain that for listeners who might not follow SaaS metrics as closely.
Sure. It's a benchmark for a quality, mature business. You take the revenue growth rate, add the non-GAAP operating margin, and if it equals 33 or more, you're in a good spot. It means you're balancing growth with real, sustainable profit.
And their ultimate goal is to get revenue growth reaccelerating into 2027 once all this transition noise is behind them.
So you have this picture of huge profit beats, bigger deals, a clear path to high-quality growth.
And yet the market sells off.
Which brings us back to those external pressures and the immediate friction.
You can't ignore the activist shadow here.
Not at all. This whole earnings report landed right in the middle of the Engaged Capital Activist campaign.
And they're publicly pushing the board to look at strategic alternatives.
Which is code for sell the company. Their argument is that BlackLine is a mission-critical asset with great cash flow, but it's just structurally undervalued by the public market.
And that fire got a little more fuel recently, didn't it?
It did. BlackLine got a big award from SAP just for the call.
Reinforcing all the speculation that SAP, a huge partner, would be a logical buyer.
Of course, management had to play it by the book. They declined to comment on any of it. Just gave the standard line about being committed to maximizing shareholder value.
But the market chose to focus on the negatives.
Right. They ignored the M&A potential. They ignored the long-term story. And they focused on 3 things. The drop in year-over-year earnings, the obvious execution risk in the transition, and the pricing friction causing customers to pause.
And the sell-side analysts followed that lead pretty quickly.
They did. Bear downgraded the stock from outperform to neutral, slashed their target. BMO trimmed their target price too.
The message from Wall Street is pretty clear then.
It's show me. Show us a couple of clean quarters.
Yeah.
Prove that this new pricing model works before we buy into the 2027 story.
So given all this conflict between management's view and the market's skepticism, it sets up an interesting bet.
It does. But first, the critical reminder.
Really important part.
Yes. Everything we discuss here is for educational and informational purposes only. It should absolutely not be considered investment advice.
You have to consult your own professional financial advisors before making any decisions. Do your own work.
Couldn't have said it better.
Okay. With that necessary caution flag waved, let's talk about an outrageous but plausible trade idea.
The stock is sitting kind of mid-range in its 52-week band. And as we said, management is buying back stock aggressively.
They think it's cheap.
They think it's a deep discount. And you have strong cash flow, and you have the activist pushing for a catalyst.
So the idea here is a long-term, out-of-the-money call option position, maybe 12 to 18 months out.
Exactly. This is not a bet on Q4 earnings. This is a pure catalyst bet. You're betting on the potential for an M&A pop. BlackLine is a valuable strategic asset. It's cash generative, deeply embedded in its customers' finance operations.
And with the SAP connection, the activist pressure, the odds of the board eventually exploring a sale seem higher than usual.
This trade is a way to capitalize on that. You're betting that a buyer would value the asset based on its strategic worth, not the temporary noise from this pricing transition.
A high-leverage bet on the market finally seeing the forest for the trees.
That's one way to put it.
Okay, so to recap this deep dive, BlackLine posted a really strong quarter operationally. Bigger deals, raised guidance.
But all that optimism was completely overshadowed by the near-term friction. The success-based attrition, the pricing pauses.
And the uncertainty from the activist campaign hanging over everything.
And that's the core conflict. Management is looking long-term, talking about the rule of 33 in 2027. The market is looking at today and demanding smooth, stable execution right now.
All right, so here's the final provocative thought we want to leave you with. Think about that term, success-based attrition. Customers needing fewer licenses because the product works so well. Is that really a headwind?
Or is it actually the ultimate validation of their entire value proposition? Does the fact that their tech is literally destroying its own revenue stream under the old model prove how necessary this new platform pricing is?
The pain they're feeling today might just be proof of how much uncaptured value they've been delivering all along.
And their entire future depends on how fast they can convert that value into actual revenue under the new model.
That's the question to keep in mind. We really appreciate you joining us for this deep dive into BlackLine. We look forward to your feedback.